All right, Fernando says, Mike, same risk. At same risk, is it better single call or butterfly plus one call? You know my answer is going to be one call. Example, buy one contract of Apple 2022, 28 January. I'm sorry, 195 call. Okay. All right. I know you gave me the risks here, but I just have to build it. So we're going January 28, and you gave me a 195 call. Weird midpoint. I'm just going to buy one. Okay. So he's looking at a deep out of the money call. Yeah, that's pretty deep. Deep out of the money, long call position here on Apple. Price of about, let's call it 115 at midpoint. It's probably going to be higher than that. Might go up to 120. We're going to call it 115 though. All right. And that's, I think, the numbers that you gave me. Okay. You said 113. We're going to use 115. Doesn't matter, Fernando. What do I have here? I have a call that's 20 points out of the money. Low probability of the stock reaching this price. Let's take a look. Probability above. Loading the history for the call. Okay. All right. So we'll take a look at that. But I know that my full risk is 115. If the stock's anywhere below 195, 35, 36 days from now, my call expires worthless, and 37 days, excuse me. The call expires worthless, and I lose the full premium. Naturally, of course, if the stock moves up to 185, halfway between now and expiration, say on the 11th or the 12th of January, I'll be looking at a small profit of $22. So it's 22 cents roughly, up to 137, 115 to 137, 10-point halfway. Okay. And if it moves up to 190, which has got to be your expectation, then we'd be trading at around a price of 277, again at midpoint, or that would put us at 162. This is theoretical, of course. So it's proud 162 at 190. Okay, great. So that's what we know we have in this long call. We know the potential. We know that if it falls, to 165, we'll probably lose about half of this right away. It's going to be very fair. Let's just see. At midpoint, or not at midpoint, excuse me, halfway point. Oh, geez, that almost went to nothing. Okay, so it's a lot worse than that. So if it drops 10 points back down to 165, we're almost at 100% loss, even at the halfway point. Yikes. All right. So Fernando's question, is it a better play to do this or look at a butterfly plus a call? Example, same expiration, I think. Yes, 28 January. Buy a 195 call, buy a 185 call. And what are we doing now? Selling two 190s. I'm sorry. Buy one Apple 185, sell two 190s, and buy. Okay, now you're going to buy two contracts. So you're doing the call and an extra call. Okay, so what does that mean? A standard butterfly would be one. Naturally, sell two in the middle. I'm sorry, at the 190 strike, I put them out of order, and buy one upper. Standard call, butterfly, bull call debit spread combined with a bear call credit spread with a 190 strike in the middle. But Fernando is going to do it this way. He's going to buy two of these 195s, essentially paying the same 113, 115 price for the call, but doubling it, getting two premiums at 190 and buying one at 185. Okay, now I'm going to clean this up. Let's put this back to 115 to be fair. Okay, well, yeah, you know my answer. Why complicate it? Here's what I'm looking at. This is going to be a much higher profit if the stock hits 190. I agree with that. What do I mean by that? When we had looked at it and said, what happens if the stock went up to 190 at the halfway point, we saw a profit potential of 162. Our 115 call we bought would have theoretically gone up to 277. So our profit would have been $162 on 115. Here, the profit would be 201. But if it keeps going up, we're giving it back and going into a second loss area. I don't like it. You know I don't like that. I don't like having two ways to lose on this position. The risk is about the same. As Fernando mentioned, 115, 116, 113, it's about the same depending on the bid-ask spreads. Although I get more profit here at this peak, it's about the same as the 187 or 188, right? We'd be at that one. Okay, so we're still about 200 here. Oh, no, I mean at midpoint, excuse me. So we're still around that 150, 160. And then it does go higher here at the halfway point. But then you've got the margin requirement. Even though you've got two calls, you've got to cover the bear call spread. The one sold at 190 versus one of these calls here bought at 195. That's what's bringing you back down in the loss as you get closer to expiration. Whereas if the stock was moving up to 194, 195 with maybe 10 days left, I still might be having a small profit or a very small loss on the long call. But here it's getting into a bigger loss zone. It's not huge. I understand that. It's not huge. But again, it's still that maximum loss range that can happen in two places instead of with the long call only happening in one. Okay. Stock's at 196. You're effectively at break even. Now you'd be both of them. You'd be at a 16% loss. Okay, so let's run the numbers. You saw they're going to be greater if we're at 190. What about at 185 at the halfway point? A 10% increase. $60 profit here. Yeah, I'm sorry, 185. Yeah, so that was about a 20, 30, 30? I'm sorry, I wrote it down wrong. A 10-point movement, I think, was only a $22 profit. Here, the expectation is 60. Again, 195 at the halfway point. That's your max peak profit there. And that's at 414. And we were only at 162 halfway point, 162 profit if it was at 195. And then, of course, if the stock drops to 165, the number's there. It's 112 versus close to 112. But see, why isn't this showing, we were looking before at 100% loss. It still is near 100% loss, 116, 114, 115. I think it's an overcomplication to do the same thing personally. But if you're more comfortable with this and your target really is 190, and that's where you're looking to maximize the potential profit, this would be better than the long call position. But also, if you're targeting 190, I could probably think of better positions to use than a butterfly with two ways to lose, or with a long call with one way to lose as well. So it's I just think it's an overcomplication. That's why it's tough. It's an overcomplication. I don't see the need to overcomplicate. You've heard me say that before, Fernando. What is the target and what is the expectation? If your target's 190 here, or somewhere, you think, hey, it could really take off and go up to 200, 210, 220 by January 28th. Okay, either position's pretty good. Though you do have to close the one spread there, of course. You'd have to close that out, but that's taken into account with the gains in the others as well. But if you're thinking to yourself, I think it might go there into those bigger prices, but really I think my target is going to be somewhere in this range, so this would perform better than the long call, then you'd also be correct. But again, if this is your real target between 196 and 184, your real expected target, you could probably do a different strategy and get a better return than this one here as well. In that case, okay? That's what's complicated about this, is that unless you really thought the stock was going to go to 220, 230, or 240 by the 28th, why would you be buying this deep out of the money 195 call? And just because this has the same risk reward, and you say, hey, this looks really cool, because it has the same loss area at expiration where I'd be losing this whole range, but it gives me a little bit better benefit if I'm wrong, and it just stays in here where I can get a profit. Well, now you want to step back and really analyze yourself a little bit, analyze the stock you're looking at a little bit more and say, look, if my target is really that the stock would be more in this range, isn't there a better, maybe non-complicated ratio position I could just do that carries a low risk, but would still give me a higher percentage return, even in the best case scenario? And you'll probably find it, okay? That's why I worry about the overcomplication. He says the loss when the stock goes up only lasts days. If the stock goes up, you profit a lot too. Yeah, and you profit also if it goes to 185 in that case. Yeah, well, at the halfway point. Yeah, we just saw that. We just did that too. So both of them had a profit in that case. Yours was a little bit higher. It's more protected than just the long call, Fernando. Don't get me wrong. I understand why you're asking the question. You understand why I'm asking my follow-up question, though, is that it seems to me that you're saying to yourself, I really think this stock could be this could really be a good play because I'm expecting Apple to be near maybe 210 or 220 sometime in January, before January 28th, and that's going to be a really successful bid. But what if I'm wrong? What if it's really in here? And then played around with some numbers and I created this structure where, hey, I can make a really strong return in this range if I'm wrong, as well as making a really strong return in this range if I'm right. But now where do you really expect the stock to go? Because if now after you've researched it, you really expect the stock to have a high probability of being in this funnel, in this range of say 194 to 186 with the potential that it could jump up, there might be better structures, better long calls, even though we have more risk. The unknown, the unexpected in the market, or the uncertainty, of course. But again, you might be able to find a better structure that matches based on your stock being in that target range that you're focusing on here, that does perform and would perform better than the long call in that situation, in this area here, halfway point or closer to expiration. But you take on the extra monetary requirement, you take on the extra value there out of your portfolio because you've got to cover that bull put credit spread of the two contracts, the 5-point spread. Yeah. Okay. Sorry. That's right. Yeah. Okay. So those are my thoughts there on that structure. It looks pretty neat. It has, like you said, it has that higher profit here, halfway point with the multi-leg positions. It has this window of profit, which I wouldn't have at expiration on the long call if I had just bought the 195 long call. But what is my true target range for the stock here? And is this the position that best matches that? Obviously, we originally thought, your original thought was probably going to be around 220, 210 or something. That's why you were looking at the long call. And you developed this cool structure that has advantages over just buying the long call. And both can profit if the stock really moves up. But again, what is the true target range you have for this position? And once you've analyzed that a little bit and thought about that, then is this ratio type butterfly or butterfly with the extra long call really the best strategy to maximize profits if that is a price range you're looking for in that case? Maybe an iron condor would be better. I don't know. Have to look at those numbers too.